when it comes to insurance, a lot of times people just don't know like what affects premiums, right? So why does my neighbor have this premium and maybe I have this one over here, right?
Because your dog keeps biting people.
So there's a lot of different factors that go in. When it comes to insurance, Evan, is there anything where someone says, what could I do to lower my insurance premiums? You would say,
transport yourself forward in time 5 years. If your insurance premiums are poor, it's going to be caused by a couple things. Credit is a huge driver in insurance, just like it is in everything else. If you can improve your credit score by working with any number of the credit professionals that we recommend, that will help your insurance premium. But the bigger factor is risk and claims factor. Risk is going to be driven by your age. If you've got teenagers driving cars in the house, oh my goodness, that is such a huge spike in cost. It's colossal. But also your zip code's a really big part of it. You know, someone who lives in the city is generally at a much higher risk of getting into an accident than someone who lives, you know, in complete seclusion. So, you know, like I've got an urban zip code. My insurance premium's higher than if I lived 3 zip codes to the west or to the north or to the south.
And you're talking auto?
Yes.
Right? Auto insurance there?
When talking about homeowners insurance, it's much more, it's region specific. You know, here in the Midwest, in the upper Midwest, we do deal with a lot of hailstorms. We're still not seeing quite the claims volume of losses on hailstorms and roofs and everything is like Florida, but we're not far behind. The amount of re-roofs that they have to take care of. But that is something that the insurance company is just going to price into everybody. So that's going to be the same for your neighbor as it is for you. Roof age plays into that big time. But the number one thing is claims history. As soon as you file a claim, you know, every insurance company has like a different statistic for this, but it's a huge increase of your likelihood of filing a future claim. Because they know you've broken that mental barrier that you go, well, insurance is there to be used. And, you know, I would agree with that, but ultimately speaking, the question of if it's worth filing a claim is as soon as you enter into that territory, the insurance company knows, and that stuff doesn't fall off your record for 5 years, which is why I said transport yourself forward in time 5 years. So I generally recommend higher deductibles than a lot of other people in my industry. Not hugely high. I would say normally about $2,000. And it's not because I think that that's like the financially prudent thing to do. You know, you're only going to save a couple $100 a year. You know, so the crossover point, if you have a claim, maybe it's worth it, maybe it's not. It's more about putting the client in the mentality that insurance is only for something that you can't afford to fix yourself. Because if your deductible is only $500, then anytime something goes wrong, I'm getting a call from my client going, well, is it worth filing a claim on this? And I go, well, yeah, the insurance company will pay you $1,000 or $2,000 to help, you know, like the neighbor kid broke your picture window on the front of the house and your deductible's only $500. Absolutely. The insurance company will cover it. You're going to get a new window and they're going to pay the, you know, $2,500 for that renewal by Anderson picture window. But your rates are going to double, and they're going to be double for several years because you didn't buy the forgiveness package, or you did and you already have one claim on your record or any number of that kind of stuff.
Gotcha.
Whereas if you put that deductible in that $2,000, $2,500 range, it puts people in that mindset that it's like, if it's just a little thing, I'll just fix it myself. If the whole roof needs to be replaced, or, you know, we have a fire and smoke damage and it's 10, 20 grand in repairs, that's when you should be thinking to make a claim, because then it's definitely worth any rate increase you're going to face.
Credit, claim history, anything else?
Those are the two huge ones for homeowners. Obviously, there's other little stuff. The condition of the property generally and the size of the property are going to drive a lot of stuff with premium. You know, you may think, hey, all of our houses in this development are the same, but if your neighbor has a roof that's 10 years newer than yours, you have a 15-year-old roof and they have a 5-year-old roof, they're going to be paying a lot less in insurance premium. And
when you say a lot, we're talking
sometimes as much as 15-20%. It also can make a big difference in what coverages you even have available to purchase. Because once your roof is over a certain age, a lot of companies will just say, we won't give you replacement cost on this. We'll only give you actual cash value, which means on a claim, you know, after your deductible, we pay a percentage of what's left, as opposed to you pay the deductible and we pay the rest, which is not as good.
So I had a client call me the other day. I'm actually doing a refinance for one of my previous clients who moved up to Walker, Minnesota, back in 2017. And so I was asking them how much his insurance was. And he said a number that was like, there's no way that can be correct. Like, that seems really high,
really far from a fire station.
So that's the exact reason. So he's like, here's why my insurance costs this. He's like, my insurance agent said, look, if a fire starts in your house, that thing burns down to the ground before any sort of fire, before the fire department can get there.
Evan, you knew right away.
Yeah, well, and that's just it too. Is it's not something that we run into a ton. Most of the work that we do is here in the cities and the kind of surrounding area. And honestly, Minnesota is dotted enough, aside from like the really rural areas and like up by Virginia, Minnesota, and so on, that you're honestly never that far away from a fire department, except sometimes you are. So yeah, there's fire risk classifications when it comes to houses. Most of the stuff we do is what we would call Category 3, which is basically you live pretty close. You're not like standing there looking at the fire department across the street from your house, but there's a fire hydrant nearby. There's a fire department that can be at your house in 10 minutes or less, that kind of stuff. And yeah, that does make it.
So let's talk about replacement costs, because that's kind of where we're leading into next here. So I'm curious now, with materials, right? So COVID does a lot of weird things, and supply chains for everything, right? There's chip shortages for cars, and obviously lumber was crazy there for a while. So what has happened in general to insurance premiums over the last couple years? Because if a house burns down now, it's more expensive to replace that house versus just 2 or 3 years ago because of material costs. Have insurance premium like floated with costs of materials and stuff?
Yes, to a degree. A lot of that stuff is already priced in. So most policies that I write include an additional percentage on the base value of the home. So what a lot of mortgage companies do, and they do this for multiple reasons, but my favorite part is it just makes this whole process easier, is they offer percentage increases on that calculated rebuild cost, because no internet calculator or whatever is going to encompass everything about your home.
Right.
No matter how detailed I get, I go, exactly 68% of your house has hardwood floors, and you've got 10% plaster walls and all that stuff. Ultimately, there's some variability in all this, and, contracting costs vary depending on, the phase of the moon and whatnot. And yeah, lumber prices can go all over the place. So we calculate a rebuild cost based off of the square footage, the materials, the location, all that stuff. And then we can add a percentage onto that to buffer for those increased costs. The main advantage of that is in the event of a widespread national disaster. So here that would be tornadoes primarily. In other areas that might be earthquakes or forest fires, hurricanes, any sort of thing where all of a sudden it's not just your house that needs construction, it's everyone in the subdivision that needs construction. Even if it's not total loss or whatever, all of a sudden this demand for labor goes through the roof and prices skyrocket. Well, if you have, a $300,000 house insured for exactly $300,000, now you're really only covered for 2/3 of your cost. Whereas if you had an additional 50% of cost overrun protection, you're still going to get a house that's the same. They're not going to build you a 50% bigger house, but they will pay an additional 50% of that rated value to rebuild your house the same as it was before.